Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Hey, so welcome back to Premier Study Investing. I wanted to take a look at an update for the modern portfolio theory. It's a test portfolio, basically, that I've been running. So you guys know I do a lot of work in modern portfolio theory. It's something they teach in graduate school. I sell these quarterly portfolio tools in Excel where you can basically pick the level of return you want. You can pick between 5% and most recently as high as 18.05%. You can decide which level of expected return you'd like to have. I've chosen the 12%, but you can pick whichever one you want. And what I'm trying to do here is to sort of prove to myself and give you some feedback as far as, does this actually work? They teach it in graduate school. It won a Nobel Prize. Basically, can you take a whole bunch of risky assets, stocks or stock ETFs, equity ETFs, basically use Excel to optimize for the best group. So take a little bit of the really high performing ones and mix those with some of the other ones that also perform well and find like your best risky basket of assets. And then if that basket is a little bit too high risk for you, so like if it has an 18% expected return like it did in this last quarter, but also it has a very high standard deviation, meaning that you're holding like a lot of risky assets, maybe too risky for your preference, then the idea is you can basically dilute those down by putting a little bit less money in that high risk stuff and just adding in some bond funds. So that's essentially the idea. The question is, does it work? So like I said, I was running the 12% strategy. And as you can see today here on the screen, we've hit that 12%. I've been running this from May 20th, 2023, until September 10th, 2025, which was yesterday. So 12.04% annualized return. Yep. So that's nice. You can see here, we're looking on the screen. We're basically talking about this blue arrow pointing downwards as the symbol. And on the list, it's the bottom one. So total returns over that period has been 30.06% return. And, well, you can see some of the other ones have done less well, particularly the Bloomberg U.S. Aggregate Bond Fund. Well, some of these other ones have really done quite well. Small caps, S&P 500 was up 61%. NASDAQ was up 70.82%. Now, we've been able to catch up a little bit with interest rates falling. And TLT is the, as I called it, the dilutive asset. Yeah, you can use something short term like SHY, BIL, and I put that in the model and I talk about that. Or you can use a longer term bond fund like I'm doing. And I wrote an article about this recently, and on a risk-adjusted return, if you went with the short-term SHY bond fund for your dilutive assets, then on a risk-adjusted return, you would have outperformed the S&P 500. Yeah, which is really nuts because S&P 500 has been on quite a rally, especially in the last 2 years. Yeah, but on a risk-adjusted return, you can't beat it using this theory. Now, I'm running TLT, which did not have as high of Sharpe ratio. Sharpe ratio, you want a high Sharpe ratio if you can get it. But I chose TLT, which has been a drag on the returns. Yeah, it's been the lower performing, we'll call it the risk-free asset, right? This dilutive asset that I want to use, this bond fund that I'm going to use to dilute down these high-risk equities. TLT has been a drag. It's been down something like 10% over the last 5 years. It's come up a little bit, so now maybe it's -8, but it's still been a drag. And yet, despite that drag, you can see today we're still achieving that 12.04% annualized return that I was hoping to receive. So I'm really happy with that because I've been able to basically achieve my goals. This isn't a primary portfolio among all the different strategies that I run, but I really want to know, is this a good long-term strategy? And it appears like it is, because even though I chose on purpose the inferior bond fund, we've still been able to hit the target. Let me tell you a little bit about TLT so you have some information on it. Okay, so here you can see it's the TLT ETF. It's called the iShares 20 plus year Treasury Bond Fund. And, really I'm a follower and student of Mark Meldrum, who does a lot of, I basically came across Mark for his CFA prep content. And so I've studied CFA level 1 and level 2. I've not yet passed level 2. But the general idea is that as we're sitting here looking at a 20 or 25-year charts, we're essentially thinking about mean reversion. All mean reversion is look at this chart and what do you think is the average price that this asset TLT trades at? It's as high as 170, and it's about as low as you can get today. Let's say probably hasn't really gotten below 82, 83. Might have been a day you could have picked it up for 80, 82 a couple years ago. To get that price prior to 2022, you would have had to gone back to like 2003 basically to pick that up. So the idea is, what is the average price? Let's say it's somewhere, we can use the line here on the screen, this dotted line. Let's say this is somewhere in the middle, say 116. This is from where we are now, $25 higher than where we are right now. And what is 25 divided by 90? Because that would be $25 increase on a $90 asset would be a 28% return. So the idea is we're going to get a better coupon, or we call it coupon when it comes to bonds, but you're getting paid more each month to hold this longer term asset, with the idea that eventually this will mean revert, meaning that interest rates will drop and the price of this will come back up, and we're looking for like a 25, 30% move, maybe even better than that. So that's the real strategy. Yes, it was a drag the last couple years on the performance, but we've accumulated, and we're hoping for a 30% run. Now this 12% portfolio that I'm talking about here, 12% actual return, it's about a 55-45 split, meaning that about 55% of the money, in order to achieve a 12% return, about 55% of the money goes into these risky assets. And they're diluted down where about 45% of the money goes into the bond fund, TLT. Okay? So 55-45 mix. One thing you should think about, there have been some discussions. I did a video, it was a couple months ago, with David Rogers Webb and Jeffrey Gundlach. So David Rogers Webb is kind of a controversial figure who wrote a book called The Great Taking. It's pretty much like it sounds, basically that there will be like a bail-in. Governments in the next big crash will essentially start taking assets. Yeah. I mean, pretty doomsday stuff, but you do hear some of that bail-in talk in Europe for unused funds, right, sitting in accounts for some kind of war effort. You know, I mean, I'm not a big expert on European military politics and things like that. Okay, who's Jeff Gundlach? Jeff Gundlach is known as the Bond King. It's kind of a title that he's been given. He started Double Line Capital. He's managing billions of dollars. He's very famous. I think he's a little bit shy of 70 years old, but he's been in fixed income for pretty much the entirety of his career. You can hear him talk. He's invited on as guest in legacy media pretty frequently. You can also catch him on the Double Line Capital YouTube channel. So Jeff is a well-spoken guy. I think I find him very interesting. He has talked about the debt. He has talked about a U.S. Treasury bond default. He has talked about like new monetary system, essentially that this one is essentially bankrupt, although it's a slow rolling type of thing. And so that's really interesting that you have a guy who sounds, kind of as extreme as David Rogers Webb, talking about the government, basically capital controls, taking people's money. I did my graduate work in Lebanon in finance, and after I left, that government defaulted. They had hyperinflation. They basically locked people's funds in the banks. They set limits on the amount of money that could be withdrawn. So I've seen that happen. That stuff happens. That's not just some make-believe stuff that can never happen. It happens. I think they are doing similar types of things in Canada for some sort of, max withdrawal limits. I don't know. I don't want to get deep into that. But the reason I bring that up is that there is basically a question from people, is the 60-40 portfolio still viable? Because this 12% return is a nominal return. It's not a real return, meaning we have to take something off for inflation. And there's a big debate is inflation running at 2.5 or 3% right now? Or is it much, much, much higher? Basically, do the official numbers not tell the whole story? I think there's something to that. I think that there is. Who was I listening to the other day? He said, well, inflation's really at like 13%. Actually, I think it was not. I don't know if I don't think it was Lynn Alden, but it was one of these podcasters, saying that they believed that inflation was very, very high. I'm sorry, I can't remember the name. I do want to look at one last thing. Essentially, running the TLT strategy, as you can see here, it's really small, but it's the iShares 20 plus year Treasury bond fund. And so if we come down here and we look at some of the characteristics, it's a whole bunch of different bonds, right? And you can see here that they actually have 43 different holdings in this ETF. The 30-day yield is 4.7%, so it's paying pretty well. The 12 trailing month yield has been 4.33, and average yield to maturity 4.73. Now, the really interesting thing that you want to find, which is not that easy to find, is, well, one, it does have a pretty high standard deviation, 16.43. This is as high as the standard deviation on like the S&P 500. I calculated it recently. I think it was right in that range, 15%, something like that. So TLT is not a low risk, even though, I'm kind of using it for the risk-free asset, so to speak. I'm basically buying it now today at really, really a low period, right? Like we said, buying it in the 80s. Yeah, it has an average of 120 or something. So picking it up really cheap right now. Yeah, and then the gamble or the play is that interest rates will drop. It will become necessary in order to basically finance the government debt in the United States. The debt is going to kill us unless we get interest rates down, which is why Trump, as you know, is on this war path to get Jerome Powell to cut rates or to get rid of him. The other really, really important thing to notice is this term called effective duration. This is when Mark Meldrum is talking about being long duration or duration trade. That's what he's talking about. The 15.79, it's essentially, you could think of it as like a multiplier effect. The technical term is it's a sensitivity. But what it means is that for every 1% drop in, what is the average weighted maturity? So 25.96 years. Let's say that there was a bond out there that was exactly like 25.96 years. Okay. If the yield on that bond was to decrease 1%, what would happen to the price of the bond? That's what effective duration tells us. Okay. So the maturity is obviously different than effective duration. But in this case, effective duration means that if you were to experience that 1% drop on these bonds, the price would go up 15.7%. Okay. So that means we would go from 90, where we're trading today, and we'd add 15 on that for every 1% drop in the interest rate of these bonds. So what we're basically saying with my mean reversion idea is that essentially we're thinking that the long end of the curve is going to come down 2 percentage points. And if that would happen, that would put us up somewhere $30 higher, essentially, than where we are today. So that would be like a 40% return. So that's the real play. And as the interest rates have come down, that's why we have a sharper curve up there at the end, more than the S&P, more than the NASDAQ, that sensitivity is really going to go crazy in our favor if there is the next crisis, or you have bank failures and the economy gets in trouble, if these job rates continue to be so abysmal or if Trump gets his way and says, look, we can't service the debt at these high rates, we're bringing them down, we're getting rid of Jerome Powell. Whatever the situation is, the idea is just to sit on like the 4.5% coupon, just collect it, just snowball it, and wait for the inevitable, right? And then get your 30-40% return, right? And basically be able to outperform the S&P 500. Yeah, I don't know if that's going to happen. That'll be really interesting to see if that duration effect can actually propel us beyond the S&P 500. That will be really interesting. But right now, we're still winning, given that we have a better Sharpe ratio. If you want to know more about the Sharpe ratio, I'll leave a link to an article that explains that in more detail. Thanks so much for joining me. We'll talk to you next time.